Good evening, guys. A very warm good evening to all of you. So let's wait a couple of minutes. Let's wait so that others can join as well. And then we will start soon. Good evening, guys. A very good evening to all of you. So three-statement model is where we left off in the last class, right? Good evening, GA. Good evening, PP. Good evening, NS. Good evening, AP, JS, KS. Good evening, everyone, AK. So Dipti, the timings have been changed for your batch from 9:30 to 11:30. That's why. So you missed last two classes. That's why you might have not got the update, but keep checking your mail about it. when will our internship start. Once you are done with uh, the core curriculum, then you will be having your exams, and then so it will be starting after the completion of the curriculum. Although internships and placements is something that is taken care by the placement team, so I won't be the best person to comment on it. They will. When is the exam? Once the curriculum is done, once all the subjects are covered, then you will be having your exams. So regarding exams or placements or anything else, okay, you can raise a ticket about it. So shall we start? Today we will be starting with ratio analysis for next few days, next 2 months at least. AM financial modeling classes will continue. KG, as like you are informed about timings, I am informed about the timings as well. So even I don't know, but it is something that management takes care of. Please share sheet. Okay, you want this sheet? Again, regarding all those clauses, all those conditions, whether scores or jobs are dependent on exams or not, again, I won't be able to answer that because I have never been into those processes. So if you have any doubt about it, you can raise a ticket. The team will get in touch with you and they will clear your doubts. I am sharing the file to you guys. So have you guys received the file in the chat box, those who have connected from laptop? If yes, we are starting with the session. Uh, you don't have laptop, how can complete this topic because the topic is also considered in the exam. So to practice, for the practice purpose, try to borrow your friend's laptop or try to spend 1 hour in a cyber cafe to get a hands-on experience. Nevertheless, in exam, you won't be asked to make a model. Although when you will have a project, you will be asked to make a model as well. So make sure you keep on practicing it, PK. Let's start with ratio analysis. Now, for ratio analysis, you can see the white screen, right? Is yes, this was the same sheet. Some of the students might have not have received the sheet. Okay, you want me to wait 2 minutes? Why? PP. Shall we start? Good evening, AP. Good evening. Ratio analysis. I am just naming the topic. So when I am switching between whiteboard and Excel sheet, are you guys able to see the whiteboard and Excel sheet? Guys, when I'm switching between whiteboard and Excel sheet, are you guys able to see whiteboard and Excel sheet? Perfect. Perfect. So the first set of ratios is growth rate. This is something that we have already done. So this is our first set of ratios. Yes, you can continue with the class on the laptop, and while practicing, you can just go with the recordings. So you can use recordings while practicing and uh, listen to the class with the laptop. That is something which is most preferable to do. Now let's start. This is growth rate. Growth rate is something that we have covered already. So let's suppose this is year one, this is year two, year three, and year 4. If in year 1 the sales is revenue is 100 and in year 2 it is 120 and in year 3 it is 132, in year 4 let's say it's 145.2. So we want to calculate that how has revenue grown this year compared to last year. So what is the formula? Here you can clearly see from 100 the revenue went to 120. What is the percentage growth rate in revenue? If the revenue has grown from 100 to 120, what is the percentage growth rate in revenue? It's 20%. Very good. But how is this 20% derived? So it is 120 minus 100 divided by 100. That is growth. If I want to name this as generalized terms, if I want to figure out the formula in generalized term, what I will have to write is year 2 revenue minus year 1 revenue divided by year 1 revenue. Can I write it this way? I've done nothing but generalize this same equation. I can also write it as this year revenue minus last year revenue divided by last year revenue. What is it? It is this year revenue minus last year revenue divided by last year revenue. Now, what is percentage? What is percentage? Percentage is anything divided by 100. So if it is 10%, 10% is nothing but 10 divided by 100. Anything which has denominator of 100 is considered to be percentage. Although this is very basic, but some people tends to forget it. So I can write 10% as 0.1. I can write 20% as 0.2. I can write 2% as 0.02. Fair enough? Fair enough? Everyone understood this point? Shall we go ahead? If anyone want to stop me here itself so that you don't lag behind the lecture. Now moving on. Let's suppose, for example, if I know that revenue growth rate is, again I am coming, KV, 10% is, I am saying percentage. Percentage is nothing but anything divided by 100. So if it is 10%, 10% would be 10 divided by 100. Do 10 divided by 100 and you will see 0.1 as the value in the calculator. Similarly, do 20% as 20 divided by 100 and you will see 0.2 in the calculator. So while working on percentage, you should be comfortable in converting percentage into absolute values. So 0.1 is the absolute value of 10%. Now, if I want to check growth rate of any term, in growth rate, we want to find growth rate of revenue, that is revenue growth rate. We want to find growth rate of gross profit growth. Next, we want to find EBITDA growth. We want to find EBIT growth. We want to find finally the net profit growth. And sixth, that is last one, we want to find the dividend growth. Now the purpose of growth rate is very simple. we need to find we need for comparing growth rate, for using growth rate is used to compare companies this year performance with respect to last year performance. Again, I am writing this down for you. Why is growth rate used? To compare companies this year performance with respect to its last year performance. So when I am comparing revenue, I am comparing this year revenue with the last year revenue, gross profit this year gross profit with last year gross profit, similarly dividend this year dividend with last year dividend. If let's say I feel from this year to last year that dividend has increased with 20%, the dividend has increased with 20%, and last year the dividend was, let's say, 1000 rupees. Last year dividend was 1000 rupees and dividend has grown with 20%. So what will be the dividend for this year? If last year dividend was 1000 rupees and dividend has grown with 20%, what would be the dividend for this year? Try to formulate it. Give me the formula to find the revenue for, dividend for this year. Every one of you are saying dividend would be 1200. Fairly agreed. But how will you come to this 1200? How have you derived this 1200? So can I write formula this year, formula for this year dividend as last year into 1 plus growth rate. And what growth rate? If we want to find next year dividend, we will be using dividend growth rate. If we want to find next year gross profit, we will be using gross profit growth rate. So I am writing over here respective growth rate. Respective growth rate. So last year into 1 plus respective growth rate. So similarly, let's suppose if you want to find EBITDA growth, what would be the formula for EBITDA growth? Can I write last year EBITDA minus this year EBITDA divided by last year EBITDA? Right? Last year EBITDA minus this year EBITDA divided by last year EBITDA. Similarly, I can also rephrase it as last year, sorry, it is opposite, not last year minus this year minus last year. This year minus last year. This year EBITDA minus last year EBITDA upon last year EBITDA. So it can also be written as this year EBITDA minus last year EBITDA minus last year upon last year. Last year upon last year got cancelled. It remains 1. So the formula would be this year growth for any element, may it be EBITDA, EBIT, net profit, revenue, gross profit, anything. The formula would be this year upon last year minus 1. Fair enough? Fair enough, guys? Now, shall we model this if you have understood the logic? Let's start with modeling it. Now, these are the rough sheets. Yes, we will cover this with an example when we will be modeling it. So you will going to see the example, the practical aspect of it when we will be applying it. So application is still remaining. Wait for a second. So I hope all these things are already been covered by you. These were rough sheets. I am deleting this. Now I want to remove the grid lines. Let's start. Alt W V G. Excel screen is visible, right? Excel screen is visible to all. Excel screen is not visible. Okay. Now is it perfect? Now you would be able to see Excel, Subhendran. I have shared the screen again. Okay, KV wants me to wait. Also, when you want me to wait, also mention the reason why do you want me to wait. If everyone of you asked me to wait even couple of minutes, okay, open Excel. Okay, fair enough. Once you are ready with your Excel, please let me know those who are practicing this with me. Ready? KV, are you ready? You asked me to wait. That's why I'm asking you. This was our historical financial statements. Okay. Let's name this selecting the whole range. Alt H M C merge and center. Alt H M C. Okay. Yes, I had shared this Excel Akshay, but now I will have to close this sheet to share the Excel. So I cannot share the Excel sheet again and again in between. So you will have to wait. I'll share it either in the break or at the end of the class. Because I had shared this Excel sheet in the last class as well. And in today's class as well, I have shared this Excel sheet in the chat box. Probably you might have joined late, so you will have to wait a bit. Now, name this as ratio analysis. Ratio analysis. I will increase the font size. I will change the font color. And I will start with my first set of ratios, that is growth rate. So we don't have meeting passwords, Asmita. You will have to log in LMS on your mobile phone and then you can join through it. We don't actually have the meeting passwords. Even I don't know the meeting passwords. I joined through a portal, that is admin portal, and even I am not provided with the meeting passwords. Probably because I don't know the logic, but what I can think of, if I am providing you with the meeting password, you can let your friends in and they can create a chaos, right? So that's why I am not been provided with a meeting password. You will have to log in the LMS through your mobile phone and then you can start. Growth rate, Alt H1. Alt H, H. So we will be starting with growth rate. First growth rate will be, but before starting with growth rate, we will add to we will need to have add few lines in between. We will navigate to this sheet and copy this. Copy the timeline. Control C, Alt SL, Alt ST. Alt HOI. Now over here you can see wrong things have been get copied. Just delete it. Now how you will delete it? Control Shift and right arrow and delete. Okay. Now let's start. The first growth rate, the first set of ratios is growth rate. And first we will be starting with revenue growth rate. Revenue growth rate. Then we will be having gross profit growth rate. Next thing, EBITDA growth rate. EBITDA growth rate. EBIT growth rate. Net profit growth rate. And dividend growth rate. Okay. Now, Alt HOI. Select this whole range, Alt HOI. Now, what was the formula for growth rate? For you guys, I'm writing the formula for growth rate. Just give me a second. Unable to copy the timeline. It shows different values and not dates. So if it is showing different values, then you will have to select that range where you are, where it is showing different values and go to date. Select that range where it has been showing values. Go to format and select over here date. Okay. Okay, it's still not working. In that case, copy this timeline, copy this Control C and use Alt EST, Alt EST formats. And then Alt ESL. It should work now. Let me know if it is still not working. Now, what was the formula for growth rate? Formula for growth rate was this year divided by last year minus 1. This year divided by last year minus 1. So when it comes to revenue, here we are calculating growth rate, not values. Here we are calculating growth rate, not values. If we wanted values, for example, if I wanted value for the next year of revenue, what I would have done last year into 1 plus growth rate that we have calculated over here, and we would have got the revenue. But we want growth rate. Okay. PM, is your problem resolved? Now, what is the formula? Last year, this year divided by last year minus 1. So the three values that we need is this year value, last year value, right? In case of 15, in case of 2015, we have this year value, but we don't really have last year value. So will we be able to calculate growth rate for 2015? The answer is no. Right? So what we can do is we will be starting with 2016. So let's start with 2016. The formula would be this year. The formula would be this year divided by last year minus 1. So this is 13%. This is what we already did. This is for revenue. Drag this. drag this, Control R. Through Control R, we can drag this. Okay, we have dragged this till 2024. Gross profit. Again, I am repeating, for gross profit, same will be applied. Same will be applied for revenue. I am repeating this for gross profit. The same steps, apply the same steps for revenue because all the growth rate formula is same. Yes, I will share the formula. And actually, I don't need to share the formula because every formula that I use, I actually put it over here in the shortcut keys. Sorry, in the notes of the cell. I actually put every formula that I use in the notes of the cell. So over here as well, you can see all the notes I have provided. So you will have to go to these notes, check out these notes. Although if you want, I can share the sheet. But I feel when you will practice this on your own and refer this, you will understand it in a better way. Nevertheless, let's start with gross profit. Similar, what I have applied in revenue, you need to apply in gross profit. So page up. This year divided by last year minus 1. This year divided by last year minus 1. Formula for EBITDA would be this year EBITDA 10,488, EBITDA of 16 divided by last year EBITDA minus 1. Because we are finding for 16, we will be starting 16 divided by 15 minus 1. When we are planning for 17, with 17 divided by 16 minus 1. Drag this formula, Control R. Go to EBIT growth rate. This year divided by last year minus 1. Net profit growth rate. This year divided by last year minus 1. And finally, the dividend growth rate. This year divided by last year minus 1. This is dividend growth rate. Okay. Alt H P. I want all these growth rates in percentage terms. That is why Alt H P. I will select this whole range again. Alt H 0. Alt H 0 because I want to keep it till 2 decimals. Okay. So are you guys done with the growth rate part? Now what does this growth rate says? Keep making this growth rate and I'll let you know what does this growth rate says. It says that the revenue in 2016 has grown 13.36% as compared to last year. The gross profit has grown 25.36% as compared to last year. The dividend has grown 40% with compared to last year, with respect to last year. Let me know once done so that we can start with the next set of ratios. Done. These are the net profit values. Okay, BK. Yes. Net profit growth shows you that how much profit, what is the growth, percentage growth rate in profit as compared to last year. Let me know once all of you are done. I have received couple of confirmations, waiting for few more. So KB is done, DK is done, AS is done, GA is done, PP is done. Hurry up, guys. Shall we start? Shall we go with the next set of ratios? Now, copy this, select the whole range. How will you select the whole range? Shift space, Control C, Shift space, Control plus. Copy this and change the name to profitability ratios. I am writing in bracket for your reference, basically margins. Remember I said in the last class, margins are profits and income is always denoted as margins. Profits and income are always denoted as margins, whereas expenses are always denoted as percentage of sales. So profits, we are trying to find out profits. First, starting with gross profit margin. Gross profit margin. Next, EBITDA margin. Next, EBIT margin, EBT margin, net profit margin. So margins would always be considered as the respective profit divided by revenue. Margins would be profits divided by revenue. Now the question is which profit? Gross profit, EBITDA, EBIT, EBT or net profit? The answer is the name of the ratio will itself tell you which profit to choose. The name of the ratio will itself tell you which profit to choose. So if it is gross profit margin, it would be gross profit divided by revenue. Whereas if it is EBITDA margin, it would be EBITDA divided by revenue. EBIT margin, EBIT divided by revenue. EBT margin, EBT, earning before tax divided by revenue. Also called as pre-tax margin. And finally, net profit margin, net profit divided by revenue. So, starting with gross profit margin. Gross profit divided by revenue. EBITDA margin, EBITDA divided by revenue. EBIT margin, EBIT divided by revenue. EBT margin, EBT divided by revenue. And finally, yeah, margins are already calculated. You can also link it directly. So is equals to link with net profit margin and you are done. Let me know once done. Let me know once done. So NS, what are margins? Margins are nothing but that particular profit divided by revenue. Not shown in LMS. Sheet is been uploaded in LMS and I am pretty much sure about it because I myself sat with the team and uploaded it. What is not shown in the LMS? Okay, gross profit margin. Margin is what? Margin is nothing but that particular profit divided by revenue. What is margin? Margin is nothing but that particular profit divided by revenue. So if it is gross profit margin, it would be gross profit divided by revenue. EBITDA margin, EBITDA divided by revenue. EBIT margin, EBIT divided by revenue. EBT margin, earning before tax divided by revenue. So to find out margins, divide that respective term with its revenue. Are you clear about this, NS? Guys, are you clear about this? The first couple of set of ratios are the easy ones. From the next set of ratios, it will be a bit complicated, but I will try to ease it down. But once you are done with this, please let me know. And if any one of you have any doubt in any of the sets, please let me know as well. Yes. So you will have to see every line item. Now revenue had grown. The revenue growth from 16, 17, 18, 19. Let's calculate. Let's try to figure this out. 16, 17, and 18 was 13, 18, 17%. Now, in these 3 years, there was an exception from 19 to 22, from 19 to 21, sorry, because of pandemic maybe. And then from 22 to 23, there was a sudden spike in the revenue. There was sudden spike in the revenue, and not only the revenue. Sorry, guys, am I audible? There was a connection issue, I guess. Okay. Okay, fine. So what I was saying is, just a second. Let me adjust this. Yes, the revenue growth in 2020, let's try to see it. It was minus 12%, minus 7%. In terms of, if we compare from 19 to 22, 86,000, around 86,000 crores of car were sold in revenue terms in the year 2019. But in the year 2022, around 88,000 cars are being sold. But still, the growth is 26%. Why? Yes, TD, you're right. It may be due to base effect. It is due to base effect. Why? Because you are comparing with a sales value or sales growth which was in negative in the last year. Because I am preparing for my MBA exams till last week, sir. Right now, my MBA have been completed. Okay, fine, fine, Ravi. Just make sure, RT, that you have gone through the recordings as well. So based on that, you can compare the ratios and analyze the ratios. What could be the impact of growing revenue? What could be the impact? What is the reason behind the impact of? So if there is a sudden spike, like I can see, there is a spike in EBIT and net profit. There is a sudden spike in EBIT and net profit for the year 2023. let's try to analyze why is that spike. COGS as a percentage of revenue, gross profit margins have been same. Gross profit margins have been same. Yes, we have. You actually, if you want to calculate, you can, but we don't really need to because net profit impact is actually calculated. So you don't really need to. Profit after tax has, the profit has almost doubled. Depreciation was around same. Tax expenses have increased. Yes, yes, all the sheets are available on the LMS. Depreciation impact is increased. Other income has increased. Okay. Other expenses have increased as well, but in line with percentage of sales. So the increase in revenue is due to increase in net profit is due to increase in revenue. Please check EBT margin once. The EBT margins have been stable from last few years, like 8%, 9%, 8%. It dropped 5% because in this year, in the year 2022, the EBT margin dropped 5%. Even the EBIT margin dropped to 5%. Depreciation charged was higher. Percentage of depreciation as a percentage of sales is lower in case of 2023. It was higher in 2022. And based on that, we are getting a lower EBIT because depreciation charge as a percentage of sales is somewhat higher. It was highest although in this year. This was 31st March 2020. So based on this, based on once we are done with all the ratios, we will be analyzing based on this. We can see that how is company expected to, all these ratios will be required. The assumption and interpretation, not only the calculation, but interpretation of these ratios will be mostly required when we will be forecasting future years. So how company has performed based on its past, the interpretation of all these ratios will be required to know that how is company expected to perform in the coming years or future years. So this is profitability ratios. Then we will be starting with mismatch in EBT margin. Pre-tax margin. Here it is 10%. We have not calculated EBT margin 9 point, it's 10% and 9.80%. So because we have taken no decimals over here, if you increase the decimals, it would be same. If you increase the decimals, we have kept it to 0 decimals. So this is just a rounding off thing. There is no difference between the margins. The margins are being same. The margins are same, 13%, 13.17%. Yeah, the margins are same. It's just the rounding off error that you feel. Next is return on investments. Return on investments. Again, I will copy this. Change this to return on investments. Now, for return on investment, operating return on asset, This is the first term. Then return on asset. ROCE, return on capital employed. And return on equity. Operating return on asset. It is nothing but operating profit, operating profit as a percentage of total assets. Operating profit as a percentage of total assets. What is return on assets then? Net profit as a percentage of total assets. Return on capital employed, return generated by both equity and debt holders. Return generated by both equity and debt holders of the company. So it is EBIT. Why EBIT? Because EBIT is earnings before paying any interest, and interest is the income to the debt holders. So what is capital? Capital is nothing but, I'll write it for you over here as well. What is capital? Total capital is equal to capital is equal to equity plus debt. We will come to that as well, Manish. Once we are done with analyzing all the ratios, we will come to that and we will try to interpret all the ratios. Although revenue growth rate, net profit growth rate, gross profit margins, net profit margins, these are the important factors that need to be considered till now in the last two sets of ratios. First two formulas, yes, I have written first two formulas as well. It's operating return on assets, operating profit as a percentage of total assets. As a percentage of total assets means operating profit divided by total asset. So yeah, that notes shift plus F2. Shift and F2 will be used. Capital is equals to equity plus debt. Returns. This is what? This is interpretation. Well, interpretation is returns generated by both equity and debt holders. So what is the return generated by both equity and debt holders? Just give me a second. Let me adjust it. Fine. Return on equity. This is return generated by equity holders. Guys, every one of you are asking for the formula. Operating profit as a percentage of total asset. This itself is the formula. Operating profit as a percentage of total asset means operating profit divided by total asset. Operating profit as a percentage of total asset is nothing but I am writing return on asset as ROA. Operating profit, that is EBIT, divided by average total assets. It should be for equity and debt holders. Operating return on assets, right? So it is EBIT. EBIT includes the return for debt holders as well, right? Return on assets. Return on invested capital. Yes, it can be included. We will come to it as well. It will be used in a later part. So I don't want to disclose it here. That is why we are not using it. Okay. Return on asset formula. Net profit as a percentage of total asset. It means that return on asset would be net profit divided by average total assets. Net profit divided by average total assets. Return on capital employed. ROCE. EBIT divided by total capital. EBIT divided by total capital. Let me just check this. Yes, I'll share this sheet after class, like always. Return on capital employed. Return on equity. It's net profit divided by average shareholders equity. Net profit divided by average shareholders equity. Now, operating return on asset. We will be starting with operating return on asset. The name itself will tell you. When you will understand the interpretation, you will yourself know when to use EBIT, when to use when to use net profit. So when we talk to calculate about what is EBIT, EBIT earnings before paying interest and taxes. So it has earnings and interest. Earnings belongs to equity holders, interest belong to debt holders. So when we want to calculate the returns on total capital, that is both equity and both debt, that is what I'm explaining, PM, that if we want to calculate about both equity and debt holders, we will go with EBIT. If we want to, because what is EBIT? EBIT is earning before interest and taxes. So before interest implies that before paying any interest, out of this EBIT, the returns to the debt holders will be paid. That is interest. What is returns to the debt holders? That is interest. So what is the earnings? Combined earnings generated by both equity and debt holders, or total capital. So when it is about total capital, when it is about operating profit, EBIT is called operating profit. So that is why the formula for EBIT, operating return on asset, is EBIT divided by average average total asset. So for average total asset, we will have to start with year 2016. EBIT divided by average EBIT divided by average total asset. Drag this formula. Why? Because it is operating return on asset and EBIT is nothing but operating profit. Return on assets. Return on assets. Net profit. Now this is only talking about returns. So we will be using net profit divided by average total asset I am using the average function to calculate average total asset. Net profit divided by average total asset. Again, total asset would be over here, this divided by this. Yes, this is operating return on assets. This is operating return on assets. Here we are available with return on assets. Sure, I am repeating both. I am repeating both. Operating return on asset is equals to operating return on asset is equals to operating profit. Now this is for 2016. I have to freeze this. So Alt, just give me a second because Zoom also gets controlled through Alt. So that's why Alt W FS. Alt W F. I don't know why Zoom is also being controlled. Just give me a second. I'll have to Alt W F F W F. Okay. Alt W F F. Perfect. Now, as you can see over here, I want operating return on asset for year. I want operating return on asset for year 2016. Alt WFF is used. Go to this cell to freeze this. Go to this cell, that is cell C8, one cell below 31st March 2015, and use Alt WFF. Why not 2015? Why not we are calculating operating return on asset for 2015? Because we need average total asset in denominator. We need average total asset for denominator. What would be average this year and last year average? So for 15, we don't have last year value, right? So how can we get the average part? That is why we are not calculating it for 2015. We are going with 2016. Operating return on asset is equals to, first go to EBIT, that is operating profit for year 2016, divided by, everyone with me till here, operating profit of 2016 divided by, now I am going to open average function, average function, AVERAGE, average function, and average of what? Average of total asset for 2016 and 2015. Bracket close, enter. This time, are you guys clear? Those who were asking me to repeat this again. Priyanka, Urvashi, PP, PM. Perfect. I am repeating it again. I am repeating it again. Please, everyone pay attention this time. Go to EBIT. Why EBIT? Because EBIT is nothing but operating profit. Go to EBIT. Divide by. Everyone comfortable till here? Those who asked me to repeat. Nikhil, Naveen, NB. Nikhil, Naveen, are you guys clear about this till now? EBIT divided by average, AVE. Go to average, select this average. Then number one would be this year total asset. Number two would be last year's total asset. Bracket close. Are you comfortable with this, Nikhil and Naveen, this time? Perfect. Similarly, return on asset would be Net profit divided by average total asset. Net profit divided by average total assets. Net profit divided by average total assets. Return on capital employed. EBIT divided by total capital. EBIT divided by total capital. Total capital is equity plus borrowings. Equity plus borrowings. Just a second. And also reserves. Sorry, we missed reserves. Equity plus reserves plus borrowings. Equity plus reserves plus borrowings. What is return on capital employed? Repeating again. EBIT divided by equity plus reserves plus borrowings. And make sure you mention this in bracket. That is ROCE. And finally, return on equity. Return on equity would be profit after tax divided by shareholders equity. Shareholders equity. No, we can't take total liabilities and equity because in these other liabilities, we have current liabilities as well, right? So we can't take total liabilities and equity because we need to exclude this component of other liabilities. Other liabilities generally comprises of all the other current liabilities. With this, we are done with return on investment. Repeat capital employed and equity. Return on equity is net profit divided by equity. Net profit divided by average shareholder equity. Let's ignore average part for now because it will be unnecessarily confusing. But always remember that while comparing income sheet ratio with balance sheet ratios, income statement ratios with balance sheet ratios, we need to take average for the balance sheet. Just a second. Yes, see. I am repeating for equity and capital employed. I am repeating for equity and capital employed. Page up. Return on capital employed. Again, EBIT divided by equity plus reserves plus borrowings. Equity plus reserves plus borrowings. Note this down. Equity plus reserves plus borrowings. So what is return on total capital employed? So EBIT divided by equity plus reserves plus borrowings. I hope it is clear this time. Is it clear PP and PM? Next, we have return on equity. Yes, ideally we should take average for of both the capitals. In fact, for capital employed as well and for equity as well. But since some of the people are not very uh, fluent with using these functions, I am keeping it basic for now. You guys are not getting same values. Okay, probably is the change very little? Is that a rounding of error or something? Return on equity, it's net income. I guess you are not getting values because you might be taking it for 2015 only. We want to take it for 2016. We want to take it for 2016. So that's why you might be not getting same values. So net income, that is 1497.20 divided by, make sure you open the bracket, divided by equity plus reserves. Make sure the values does match 5497, 151, 304, 465. Now it is matching perfect. Very good. Alt H P, Alt H 0, Alt H 0. Now, do you guys need a short break? 5 minute break? Not matching? Still not matching PP? Okay, GA is saying no. Rest all of you are saying yes. Let's take a short break. Yes, I'll share the file in the break as well. Yeah, GA is saying no for break, but all of you want a break. I think it might get heavy for someone else. So if it's not matching, it's fine. If the error is small, it is fine. But make sure that you have used the same formula. 0.2485. 2485. And this is what we were getting as well, right? Just give me a second. Just give me a second. Let me share the sheet and I will open the sheet right back. Twenty-four point eight five. That is fine. 24.85 is the right answer. 24.85 percentage. 24.85 is the right answer. This is the values that you guys are getting right. Perfect. It's absolutely correct. Still difficult in Android, Excel in tab. Yes, for that you will have to go through the recorded lectures. Guys, go on a break, be right back, take a sip of water and be right back. We will be starting. Return on equity, net profit divided by shareholders' equity. Try to match your formula with this one. Is this the same formula? D50, D61, D62. Return on equity, return generated by equity shareholders. Returns generated by equity holders of the company. Equity holders or shareholders of the company. What is the formula? Net income divided by average shareholders equity. Net income divided by average shareholder equity. So for now, let's not include the average part. Let's ignore the average part for a bit. Net income divided by average shareholder equity. Make sure that you use simple brackets in denominator. Make sure that you use this. So here, yeah, that is the ideal formula that need to be used. Once we will be done that with that, let me mark this where we have not used average. We will be doing that. We will be changing this formula. But to keep it simple for now, I have just taken shareholder equity, but ultimately we need to take average shareholders equity. So we are going to discuss average part again. We will be coming back to the average part. But EBIT divided, no return on capital, yes, EBIT divided by average shareholders equity. Formula for return on equity, net income divided by average shareholder equity. Return on capital employed is EBIT divided by average capital. Average not only shareholder equity, but average capital. Doubt from, can you please show your net cash flow values? My net cash flow values are these. Return on equity, for return on equity, you have average shareholder equity in denominator. For capital employed, you have average capital. Capital is equity plus debt. Now, PM, are you there with the net cash flow values? And these values, these are, we need to copy it, drag this. Fine. Perfect. Guys, be right back from break. In next 1 minute. We will be starting with a new set of ratios, that is activity turnover ratios. A very important one. Average shareholder equity. I'm coming to that. That is why I have highlighted these two set of ratios, right? Because I am going to change these ratios and incorporating the average part in these ratios. I have highlighted these two ratios because I am going to change these ratios. So hold on your thoughts for a while. Let me just get done with all the rest of the ratios and then I'll come back to it. Shareholder equity is, what is shareholder equity? Equity share capital plus reserves. So add this and take average of these two. Add this and take average of these two. Two people, GA and Priyanka, are, I'm really impressed by these two people. They are really attentive in class. I think they practice these as well. And based on the response they gave, I'm really glad with their responses. So keep it up, guys. Both GA and Priyanka. And rest of the guys, please do practice in weekdays as well. Please do practice in weekdays as well. So this is cash flow statement. You can take a snip of it. This is cash flow statement. You can take a snip of it if you want and then keep on matching it, or else I will share the sheet with you. I am going to share the sheet with you. Let me start with the next set of ratios, that is activity turnover ratio. For cash flow statement, PM, for cash flow statement, you are getting different values. ROE. Okay, for ROE, you are getting different values. Have you done net profit divided by, have you used this net profit divided by bracket open? Make sure that you open this bracket, equity plus reserves. And have you done this for 2016 only? We practice in weekdays because weekly classes are enough for a week. Enough for a week. Weekend classes are enough for a week. I think you are saying that, Nikhil. Okay, okay. When we will go back to the sheet, we will see what is happening. You are able to see the screen, right? Where I'm scribbling the name of activity turnover ratios. Okay. Okay. We will see what is the error. If you are not able to find the error, raise a ticket about it and I'll try to help you out. Activity turnover ratios. First, receivable turnover ratios. Also called as, in India, we use terms like creditors and debtors. So also called as debtors turnover ratio. When I, okay, thank you, PM. So what I am saying is, in India, we use terms like debtors and creditors. These are a bit confusing terms, and while studying, I too got used to get confused between debtors and creditors. So the term receivable and payables make things simpler. Receivable turnover ratio, payables turnover ratio, also called as creditors turnover ratio. Third one, asset turnover ratio. And fourth one, fixed asset turnover ratio. Last one, fifth one, is inventory turnover ratio. Now, the only shortcut that you need to remember, open your notebooks and please do write numerator will always be sales. Just a second, let me see. Numerator will always be sales or COGS. Numerator will always be sales or COGS. Sales or COGS, cost of goods sold. And COGS will be for, I'm writing this with a different color pen purposely. COGS, sales and COGS will be the numerator in every case. Sales and COGS will be the numerator in every case, and COGS will be for payables and inventory. COGS will be for payables and inventory. For rest, every value we will be keeping revenue or sales. And denominator, what is a ratio? Ratio is nothing but numerator divided by denominator. We have figured out the numerator. Numerator will be either sales or COGS. And in majority of cases, it would be sales. Numerator divided by denominator. we need to figure out denominator, and denominator is the simplest thing because denominator, what will be in the denominator is given by the name of the ratio. And what will be in denominator is given by the name of the ratio. So numerator will be either sales or COGS, and what will be in denominator is given by the name of the ratio. Now, based on this logic, based on these two are the only points that you need to remember for activity turnover ratios. Based on that, you will be remembered or trying to understand the formula of each of the ratio. For receivable turnover ratio, for example, numerator is what? Numerator is the first term. Denominator is the second term. Receivable turnover ratio, sales. Actually, there should be credit sales, but often the information about credit sales is not straight away given to us. Indirectly, although we can calculate, but still, the receivable turnover ratio is equals to sales upon average receivables. Payable turnover ratio, COGS upon average payables. Inventory turnover ratio, COGS upon average inventory. Asset turnover, that is total asset turnover ratio, sales upon average total assets. And fixed asset turnover ratio, sales upon average fixed assets. Now, what does this ratio mean? If just give me a second. Starting with inventory turnover ratio first. Interpretation, inventory turnover ratio, as because it is simplest to interpret. The speed of inventory to be converted into sales. The speed of inventory to be converted into sales. First, you guys need time to note down this? Note this down because this is really important. Yes. I have moved the page. Let me know once done. Yes, I have not explained any of the item yet. I am explaining everything one by one. Okay. Could you please repeat once what COGS will cover? COGS will cover. COGS is nothing but cost of goods sold. So let's suppose you have sold car worth rupees 10,000 crore. What was your cost of producing that car? What cost did you incur to produce that car? That is cost of goods sold. Guys, are you guys done? Please be quick. The speed of inventory to be converted into sales. Next is receivable turnover ratio. What is the formula? Sales upon average receivables can also be written as credit sales or sales times of receivables. Basically, what does that mean? Let's say if inventory turnover ratio turn out to be six times. Let's say inventory turnover ratio, like all the other ratios till we saw till now, was expressed in percentage. Activity turnover ratios are expressed in times. Times multiply x, small x. That is times. Okay. Now, inventory turnover ratio, let's say if it is 6 times, it means that in a given year, in one given year, you produce inventory 6 times and sell it. You produce inventory and sell it for 6 times. So what I am saying is, let's suppose it takes 60 days for you to produce an inventory and sell it. Let's say it takes you 60 days to produce an inventory and sell it. So in a given year, you will producing this inventory from first day to 68th day, from 68th day to 120 day, 120 to 180, 180 to 240, 240 to 300, and 300 to 360. Off means credit sales times of receivable, multiplication, times of receivable. What I am saying is, let me complete inventory turnover once. Let's suppose you are making inventory, you are keeping inventory worth rupees 1,000. You will be making sales worth rupees 6,000. If you are keeping average inventory of 1,000 in your go down, you will be making sales worth rupees 6,000 because it takes you on an average 60 days to complete one sales cycle. Then again, you will complete one sales cycle, then again. So 6 times in a year. What is inventory turnover ratio? If you are keeping inventory worth 1 rupees, you will be making 6 rupees of sale. If inventory turnover is 6. Receivable turnover, if you are giving, let's say receivable turnover is 3 times. It means that if you are giving 1 rupees as receivable, you will be able to make credit sales worth 3 rupees. If 1 rupees is given as receivable, 3 rupees worth of credit sales can be made by you. Okay. Asset turnover ratio. Let's suppose you have set up a plant, property, equipment, or a manufacturing unit. If the asset turnover ratio is, let's say, 9 times, what is the formula for asset turnover ratio? Assets upon, sorry, sales upon total assets, average total assets. Sales upon average total assets. Let's say that asset turnover ratio is coming to be 9 times. What will that mean? That would simply mean that if total asset is worth, if you have spent 1 rupees in total asset, if you have spent 1 rupees in total asset, you can make 9 rupees of sale or 9 times of sale worth of assets, that worth of the amount that you have spent in your assets. Repeating again, if you have whatever may be the amount you have spent on assets, if asset turnover ratio is 9 times, you can make sales worth 9 times of the amount spent on total assets. Let's say fixed asset turnover is 12 times. Fixed asset turnover is 12 times. It would mean that if you are making 1 rupees of expense, 1 rupees of capex on fixed asset, you will be able to make 12 rupees on sale using that asset. You will be able to make 12 rupees of sales using that asset. So that was asset turnover ratio and fixed asset turnover ratio. Finally, COGS upon average payables. That is payable turnover ratio. Payable turnover ratio. What is payable turnover ratio? COGS divided by average payables. That is payable turnover ratio. COGS divided by average payables. The speed of payables to be converted into sales. Let's say if payables turns out to be, average payables turns out to be 4.5 times, what would that mean? It would mean that if your supplier is giving you 1 rupees on credit, if your supplier is giving you 1 rupees on credit, that would be your payable. If your supplier is giving you 1 rupees on credit, you will be able to make 4.5 times worth of sales, 4.5 times worth of COGS, or 4.5 times out, 4.5 times of that 1 rupee, that is 4.5 rupees of sales in a given period. So let's say if your supplier is giving you 10,000 rupees on credit, you will be able to sell 45,000 worth of that good. 45,000 worth of that good. So 4.5 times of the supplier, what he gives you the amount on credit, out of that 4.5 times would be sold by you in a given period. So any ratio is nothing but numerator as a percentage or times of denominator. Now someone was asking me what is times of. Someone was asking me what is times of. So let's say if 9 divided by 3 is 3, or 12 divided by 4 is 3, 4 is 3 times of 4 is 3 times of 4 into, sorry, 12 is 3 times of 4. 12 is 3 times of 4. 12 is 3 times of 4. So numerator times of denominator. Numerator as a times of denominator. Now, I want to know from your side, what have you understood? We will go one by one. What have you understood about receivable turnover ratio? So that I can know whether what you have understood is up to the mark or correct or not. What have you understood about receivable turnover ratio? If you have not understood, mention that you have not understood anything. What have you understood about receivable turnover ratio? Conversion of receivable into sales. Very good. Very appropriate. The speed of receivable to be converted into sales. The speed of payables to be converted into COGS. Sort of credit sales converted into sales. Okay. How many times of credit sales are you able to make of the receivables that you give? How many times the receivable are turning around the year as we are making credit sales? Very good. Efficiency of converting debtors. Debtors are receivables and managing creditors. Efficiency ratios that measures the company's ability. Ability of what? Conversion of average payables into sales. Okay. ₹1 in asset, fixed asset, how much sales is generated out of it? That is asset turnover ratio and fixed asset turnover ratio. So Chetan is saying if you invest ₹1 in asset or fixed asset, how much sales is generated out of it? Speed of receivable to be converted into sales. Efficiency ratios that measures company's ability to revenue. In how many days receivable convert? No, we have not came to days yet. That is days of receivable is different. Days of payable is different. That is cash conversion cycle. We have not discussed days yet. When we will be covering days, you will know this. You will be crystal clear with this. But let's get done. Let's get done with modeling the activity turnover ratio. And trust me, guys, once I will be coming to cash conversion cycle where we will be saying receivable days, payable days, and inventory turnover days, you will be more clear with it. You will be more clear with it. Consider receivable, payable, and inventory days that the ability of that particular receivable to be converted into sale, the speed of a company to convert its receivable into sale, the speed of the company to convert its payable into sales, the speed of the company to convert its inventory into sales, the speed of the company to convert its receivable into sales, the speed of the company to convert its payable into sales, and the speed of the company to convert its receive receivable, payable, and inventory into sales. Fair enough. Alt HHN. Let's copy this. Formula used to quantify, so it is easy to measure. Fair enough. Yes. Now, I will be mentioning the formula here as well. We are discussing activity turnover. I know you might have not got 100% satisfaction with what we have discussed yet, but trust me, this was half the explanation. This was half the explanation. Even if you have got 50, 60, 70% satisfaction, it is fine. It will be converted into 100% when we will be covering cash conversion cycle. Activity turnover ratio, receivable turnover ratio, payable turnover ratio, inventory turnover ratio, receivable turnover ratio, sales divided by average receivables. Payable turnover ratio, COGS divided by average payables. Inventory turnover ratio, Shift F2. Shift F2 is the shortcut to adding notes. Inventory turnover ratio, COGS divided by average inventory. Now, you guys, I am really strange and shocked that none of you asked me that, sir, for fixed asset turnover ratio or for asset turnover ratio and fixed asset turnover ratio, still I am giving you a hint that what doubt should you ask? I have not disclosed the doubt yet. Think about what doubt should you ask me? And none of you asked me this. Sales. Meanwhile, when I write the formula for asset turnover and fixed asset turnover, yes, asset current contains both current and fixed. Sales divided by average total assets. Meanwhile, I am completing the formula. Think what doubt should every one of you might have asked me and you didn't ask me. Sales divided by average fixed assets. Take a moment and try to find the doubt that I am expecting you to ask me. What is that doubt that I am expecting you to ask me? Yes, assets do difference between assets and fixed assets. That is not a doubt. It's simple that assets come has current assets as well as fixed assets. Fixed assets has only fixed asset. That is non-current asset. Have total asset current plus fixed asset turnover as ratio will have total asset current and fixed. That is not doubt. That is the fact. Can be said as higher the better or lower the better. Yes, that is something that we will see. That is the analysis part of it. This is one good doubt that you should have asked me. But this is again pretty much simple. What is receivable turnover ratio? Speed of receivable to be converted into sales, higher the better. Speed of payables to be converted into sales, higher the better. Speed of inventory to be converted into sales, higher the better. Payable turnover ratio, although that is different thing. We will come to analyze payable turnover ratio as well. But we will be deciding whether it is higher the better or lower the better once we are done with the cash conversion cycle. Asset turnover and fixed asset turnover, obviously higher the better. The more sales you generate out of the assets that you have used, the better it is for the company. Same for inventory, same goes for receivable. Payable is somewhat different. We will discuss about payable. Why are we talking about fixed assets separately? Because fixed assets include property, plant, and equipment, and this is in your company for a longer period of time, like more than 1 year. We cannot rely on current asset because it keeps on changing within a year. So that is why we are analyzing fixed assets separately. What I am, so probably working capital turnover ratio, no, that also need to calculate. Okay, we will calculate that as well. Sales upon average working capital. So you can calculate multiple turnover ratios. The question that I was expecting you to ask me, or probably you might know the answer, that is why you are not asking me. So now I am going to ask you this question, that why COGS in being used in payables and inventory, why these two ratios have used COGS, and why for the rest of the ratios have we used sales. For asset, fixed assets, receivable, we have used sales. For payable and inventory, we have used COGS. Why? Why only for payable and inventory have we used COGS? Priyanka, are you want to try? No. We need to pay inventory and payable. No. Bought goods on credit as we take credit to produce goods. Although close, but not very accurate. Because cost of goods sold is to be paid to suppliers, very close. Now, what is payables? Payables are the value paid to suppliers. Payables are the value paid to suppliers. Okay, you want me to wait? You want to try on your own? Average value of its inventory for the same period. Since we bought goods on credit, we need to calculate on COGS. Fair enough. Payable, payable and inventory both are recorded at purchase price. Payable and inventory both are recorded at purchase price. The correct? I am going to pay back the supplier the purchase price that I have taken. The purchase price that has been decided between him and me. As payables need to pay before interest, depreciation, and all the other expense. No, even sales are recorded before payables, interest, depreciation, and all the other expense. No worries, I am telling you what happens. So payables and inventory both are recorded at purchase price. What is purchase price? Let's suppose I have bought 10,000 worth of goods from Priyanka and I have sold those goods on 20,000. So I am going back to pay Priyanka only 10,000, right? I am not going back to pay back Priyanka 20,000. I am going to pay back Priyanka only 10,000. Why? Because that was the purchase price from me. Let's suppose the goods are not being sold yet. If the goods are not being sold yet, it will remain in my inventory. It will remain in my go down. And at what price will I record that goods that I have purchased? At the purchase price. That is why inventory and payables are recorded at purchase price. Therefore, we are not using this this ratio does not include profit because profitability ratios deals with profit. This is activity turnover ratio. It has nothing to do with profit. That is why it does not include profit. Now, payable and inventory are recorded on purchase price. That is why we use COGS and COGS for both the cases. Whereas receivable, asset turnover, fixed asset turnover, we use for sales. Receivable is recorded on sales price. So when I am selling something, I am receiving back the money based on that selling price. Asset turnover and fixed asset turnover are used to analyze that what are the sales that I have generated on the amount that I have spent on my assets and fixed assets. That is why it is recorded on sales. Now just implementing the formula, help me with this, is equals to receivable turnover ratio is sales upon sales divided by, see again, it's average receivables. Sales divided by average receivables. Sales divided by average receivables. Payable turnover ratio. We don't have values separately for payables, but because this is the template made by Screener, this model has the template made by Screener. We can go to the raw balance sheet and check the value of payables, and based on that, we can calculate. For now, let's consider other liabilities as a proxy for payables. Consider other liability as a substitute of payables. Although we will change it again. Other liabilities, consider other liabilities as a proxy or substitute for payables. Other liabilities does include other items as well other than payables, but payables is a part of other liabilities. So we are considering other liabilities as a proxy of payables. So is equals to COGS divided by average payables. COGS divided by average. COGS divided by average payable. Inventory turnover ratio. COGS divided by average inventory. COGS divided by average inventory. Asset turnover ratio. Sales divided by average of total assets. Sales divided by average of total assets. And finally, fixed asset turnover ratio. Sales, sorry, sales divided by average of fixed assets. Now, I will drag all these formulas. I will drag all these formulas and use control 1. Select the whole range and use control 1. Go to go to custom, change this 0 type to 0.00 x. Click on 0.00 x. Select this 0.00 and write x. Click on OK. And then you're done. Okay. Now, are you guys done? Are you guys done till here? Payables and inventory. COGS upon average. I'm writing this again for you. What was the formula for payables? COGS upon average payables. So COGS for 2016 divided by average payables. Payables. We are using other liabilities as a proxy of payables, although we are going to change it tomorrow. Payables, inventory, again, we are going to use COGS. So go to historical, select COGS divided by average inventory, this comma this, control R. Done. Guys, everyone, are you guys done till here? Let me cover the last topic for the day, that is cash conversion cycle. Is it okay if we extend for 5 minutes more? Can you show which format? Yes, I am showing that. Cash conversion. It's very simple topic. It's very basic topic. That is cash conversion cycle. It would hardly take a couple of more minutes or 5 minutes more. Let's get done with this key. Since we are going very slow, we are lagging behind the subjects. That's why. Can you show which format? I have selected the whole range, control 1, went to custom, selected 0. Selected or type. If it is not appearing in front of you, type 0.00 and write X. 0.00 space X. Okay. Now cash conversion cycle. The formula for cash conversion cycle is First of all, we need to realize receivable days, receivable days, inventory days, payable days will give me, and finally we will come to cash conversion cycle. Yes, the sheet is for the last week already uploaded on LMS. This sheet will always or again will be uploaded on LMS as well. Receivable days is equals to 365 divided by 365 divided by receivable turnover ratio, 365 divided by inventory turnover ratio, and 365 divided by payable turnover ratio. Cash conversion cycle is receivable plus inventory minus payables. Receivable plus inventory minus payables. Again, I will select the whole range. Control 1, go to custom, go 0, and write days over here. Days, because why I want these in days. Cash conversion cycle is in days. I will have to write days in bracket. And yes, now inventory and payable value is same. Why? Okay, sorry. 365 divided by inventory days. Now, it would hardly take 2 minutes. I am saving the sheet. We won't get back to sheet. Sharing whiteboard with you. I know, guys, it is getting late. Just a couple of minutes, just 2 minutes more. Just the last 2 minutes. Yes, the sheet will be shared. The sheet will be shared. Formula for cash conversion cycle. Receivable. Yes, that is what I am explaining over here. Receivable plus receivable days. Receivable days plus inventory days minus payable days. Now let's say this is a timeline. This is the day 0 where I ordered or purchased inventory. This is 15th day where I made the payment. Payment made to supplier, where I made the payment to the supplier. This is day 30th. This is day 30th day where payment was made to supplier, where you sold the product. And this is day 45th where you received payment from customer. Now, the day between you purchased inventory till the day you sold the product, this was the period for which inventory was in your hands. So it was inventory days. These are the days in between the inventory was in your hand. Here the payment was made to the supplier. Okay. You have sold the product and you have received the payment. You have sold the product and you have received the payment. So this is the time for which you have given the credit. So this is receivable days. And this is the period for which your supplier gave credit to you. So payable was outstanding for these days. So this is payable days. Now I want to find this day. I want to find this period. I want to find this period. So can I write this period is what? Payment made. Just give me a second. I want to find this period. This period. This period. What is this period? This period is the period from which I made the payment. I put in my cash in my business. And on this day, I got my cash back. My cash was converted back to me. So this period is called cash conversion cycle. Cash conversion cycle. Working capital, also known as working capital cycle. Now, from the day 0 to day 45, it takes me to order the product and sell it. Order the product and sell it. So from day 0 to day 45, it took me to order the product and sell it. But do I need to put money for all the 45 days? The answer is no. Why? Because the initial 15 days is funded by my supplier. The initial 15 days is funded by my supplier. So what are the number of days for which I have to put my own money into the business? That is cash conversion cycle. That is cash conversion cycle. That is cash conversion cycle. This is the period for which my money is into my business. And how can I get this? It is very simple. Inventory days plus receivable days. But I want only this period, right? I want only this period. So I will remove this impact. I will delete the impact of this period. And how I will delete this? So inventory days plus receivable days minus payable days. How to convert in days? How to convert in days? Let's say if it is receivable days, it would be 365 divided by receivable turnover ratio. So higher the speed, what was receivable turnover ratio? The speed of receivable to be converted into cash. So let's say receivable turnover ratio is 6. So receivable days would be 60. Let's say receivable turnover ratio is 10. So receivable days would be 36.5. So higher the speed of converting the receivable into cash, the time that you take to convert the receivable into cash would be lower. And if you are converting receivables into sales in 36.5 days, you are able to convert it 10 times in 1 year. If you are converting receivables in 60 days into sales, you will be able to convert this 6 times in 1 year. That is receivable days. So I know it is getting late. This was how to convert ratios into times in Excel. Okay. So this was it for the day, guys. Let me just upload the sheet for you. Although we are going to come back to this, we are not going to, if you guys have not understood this, we are going to come back to this tomorrow. I know it is getting late for some of you. In fact, all of you. So I have posted the sheet in the chat box. Good night, have fun. But someone wanted to check how to convert this into times. So let's suppose if all these are in percentage terms. So I will select this whole range, Control 1, go to custom, select 0 is given over here. Change change this type to blank cell. 0.00 is what I will write and use X. Is whiteboard visible? Is whiteboard only visible? Is Excel screen not visible to you? 0.002 X, click on OK, and then yes, you are done. Perfect. You want whiteboard as well? Let me give you whiteboard as well. So similarly, you will have to select. Similarly, you will have to select days. Select whole days. Go to control 1. Go to custom. Delete this. 0 bracket open. Days bracket close. OK. Control S. Select the whole range. Control 1 custom. Type 0 and in double inverted commas write days. And yes, you will be done with that. Type this in custom and then you will be done. I have mentioned that in the chat box. So that was it for the day, guys. Tell me, do you want to repeat me tomorrow about cash conversion cycle again? Or have you understood it? Okay, I'll repeat it. I'll repeat it for a few of you. Okay, few of you have understood it. 2 people are asking me to repeat AR, PW, negative. Yes, we will be discussing what does negative cash conversion cycle mean. But GA, since you will understand what I'm trying to say for you, this is negative cash conversion cycle means you don't need to put your own cash or working capital into the business. Not working capital, but cash into the business. Your payables are sufficient enough to fund your working capital requirements. So what does that mean is, GA, that let's suppose you are selling goods in 10 days and your supplier is giving you credit for 50 days. So you can borrow from supplier, sell the goods 5 times and then pay back to supplier. That is what negative working capital cycle means. Yes, it is good for the business. It is absolutely good for the business. So thank you. Thanks a lot, guys. Bye-bye. Have fun. See you again tomorrow.